Right now, tonight, if you passed away, your family could not walk into your bank and withdraw a single dollar. Not tomorrow, not next week. A will would not open that account. A notary stamp would not open it. Even a fully paid estate attorney would not open it. There is one form, completely free, that bypasses the entire mess, and almost nobody tells people it exists, because the people whose paychecks depend on the current system have zero incentive to hand you the shortcut. My name is Lana Maines. I sit across the table from bank compliance officers and IRS agents on behalf of everyday families, and every week I break down exactly what protects your money and what quietly puts it at risk. If that's useful to you, hit subscribe, because today I'm walking you through the single most preventable financial disaster I see, and it has nothing to do with the stock market or a bad tax year. It's a grieving family standing at a bank counter being told they can't touch money that is legally theirs because one 10-minute form was never filed. Let's start with why your will has no power at that counter. The Uniform Probate Code was finalized in 1969 by the National Conference of Commissioners on Uniform State Laws, and it did something most people were never told about. It placed bank and credit union accounts on a separate legal track from your will, treating them as contracts between you and the institution rather than property distributed by a judge. Every state has adopted some version of this framework since, and courts have upheld it consistently for decades. What that means in plain English is this: the contract you signed with your bank, not your will, not your trust, not the binder your attorney handed you, decides what happens to that account the moment you die. A signed beneficiary line on a bank form overrides a notarized, witnessed, attorney-drafted will every single time. Your will still controls your car, your furniture, your jewelry, the physical things in your house. It has no authority whatsoever over the cash sitting in your checking account. If there's no beneficiary named, that account doesn't pass to your children. It passes into your estate, and the second it does, probate switches on automatically. Probate is the court-supervised process of validating a will and distributing what's left of an estate, and most states set the threshold for triggering it somewhere between $50,000 and $100,000. For most people who've worked their whole lives and saved responsibly, that threshold is nothing, and probate is not fast. Nearly every state builds in a mandatory creditor window, typically 3 to 6 months, during which any hospital, credit card company, or unknown creditor can step forward with a claim before your family sees a cent. Meanwhile, the funeral home still wants payment. The mortgage still comes due. Grief does not pause your bills, and the court is not working on your timeline. To see how this actually plays out, picture a woman we'll call Dorothy. 71 years old, a retired school teacher, recently sold the family home and walked into her local bank with the proceeds, $350,000. She opened a standard savings account, paid an estate attorney $800 for a will naming her 2 adult children equally, and put that will in a lockbox, believing everything was handled. It wasn't. When she passed, her children flew in, were handed an $11,000 funeral bill, and walked into the bank with the death certificate and the notarized will. The branch manager looked at the account, looked at the paperwork, and slid it all back across the counter. There was no payable on death designation on file. The will meant nothing to that contract. The account was frozen, and her children put the funeral on credit cards at over 20% interest, while $350,000 sat untouched 20 feet away. Then came the probate filing fee, the newspaper publication notice required to alert unknown creditors, the executor's bond, and an attorney's percentage-based fee on the gross estate that ran past $10,000 on its own. 14 months later, the family finally received what was always theirs, $12,000 lighter and over a year behind. Dorothy didn't make a mistake. She did what most people are told to do. The system simply wasn't built to respond to a will at a bank counter, and it worked exactly as designed. That story plays out in 3 specific ways, so before I explain the fix, go pull up your bank account right now, online or on paper, and look for a beneficiary field. If it's blank or you can't find it, that's your answer, and it tells you exactly which of these 3 traps you're sitting in. The first is simply having no beneficiary on file at all. You opened the account years ago, nobody asked, you assumed the will covered it, and it doesn't. On a modest account, this can quietly eat a meaningful share of the balance in filing costs alone before your family sees anything. And even wealthier families also assume their estate attorney already filed the paperwork with the bank. They almost never do. Wills and bank beneficiary forms live at 2 completely separate institutions, and no one connects those dots for you. The second trap is more dangerous because it feels safe. You named a beneficiary decades ago, an ex-spouse, a parent who has since passed, a sibling you're no longer close with, and that name is still sitting on file. The bank sends the money exactly where that old form says, regardless of what your current will states. Courts have ruled on this repeatedly, and the outcome never changes. The designation on file controls, not the more recent document in your lockbox. The third trap is the joint ownership assumption. Many couples believe marriage alone transfers everything automatically to the survivor. But in a number of states, that simply isn't true without a specific joint tenancy designation on the account itself. And there's a hidden danger inside the most common fix people try: adding an adult child directly onto the account as a joint owner. The moment you do that, the law in most states treats that money as partly theirs immediately while you're both still alive. If that child is sued, divorced, or owes back taxes, your savings can become part of that exposure. It's a well-intentioned move that can backfire badly. All 3 of these failures share one solution, and it's a single free form available at your bank this week. It's called a Payable on Death Designation, or POD. The concept traces back to a 1904 New York court decision, Matter of Totten, which established that money could pass directly to another person at death without a formal trust or court involvement. That principle is now codified across all 50 states. A POD is not a will and not a trust. It's a direct instruction to your bank that operates on the exact same contractual track that froze Dorothy's account, which is precisely why it bypasses probate entirely. Your beneficiary shows up with a certified death certificate, the bank verifies the designation, and the funds move, often within a day or 2 at smaller banks, and within 3 to 5 business days at larger ones. Every FDIC-insured bank is required to offer it. It costs nothing to file, and there's nothing to maintain. Here's where most people stop too soon, though. A POD only covers the individual account you filed it on: checking, savings, or a money market account. It does not automatically extend to a certificate of deposit at the same branch, which needs its own separate designation. Brokerage accounts use a different form entirely called transfer on death, filed with the brokerage firm, not the bank, and without it, stocks and mutual funds go straight into probate just like an undesignated bank account. Retirement accounts already operate under transfer on death rules by federal law, but most people filled those forms out decades ago and never revisited them, and under federal law, that named beneficiary overrides a will or even a divorce decree. If an ex-spouse from the 90s is still listed on an old IRA, they can legally collect the entire balance no matter what your current documents say. And don't overlook the safe deposit box. Banks are required to seal those boxes the moment they're notified of a death, key or no key, so if your will is sitting inside one, your family can face a circular problem. They need the will to open probate, but they need a probate order to open the box. The fix is simple. Add your child as a joint renter on that box directly at the branch. So before you close this out, here's exactly what to do. Go to your bank this week, in person or through your online portal, and ask for the Payable on Death Beneficiary form. If the teller doesn't know what that is, ask for the branch manager. Name a primary beneficiary using their full legal name, date of birth, and social security number, not a nickname and not my children. Name a contingent beneficiary, too, in case your primary doesn't outlive you. Submit the form and get written confirmation that it's on file, and keep that with your important papers. Check every account separately, because checking, savings, and each CD all need their own form. Call your brokerage about a transfer on death designation for any investment accounts, and review your retirement account beneficiaries directly with the plan administrator. Then revisit all of it every few years or after any major life change, a death, a marriage, a divorce, a new grandchild. Tonight, as things stand, your family still can't touch that account. That's not a flaw in the system. It's the system working exactly as it was built to work. The POD form is the one document that runs on the same track and wins. Go ask your bank for it this week. It costs nothing, it takes 10 minutes, and if this helped you see something you'd missed, subscribe for more.